during these markets, when they're dominated by headlines, it's important to refocus on corporate earnings, which really surprised on the upside in the first quarter, and companies are flush with cash right now. You have balance sheets that are stronger than ever, and we're just waiting for this trade war and all these tariff talks to shake out. Anytime you have markets dominated by headlines, it always takes some time to work through, but it refocuses on earnings at some point.
Agreed. The earnings have been good. 75% of companies, according to Refinitiv, have beaten their estimates. But now we have higher tariffs. Don't we have to ratchet down some earnings estimates the longer this trade fight goes on?
Absolutely. We see three scenarios in this trade fight. The first one, quick resolution. It happens over the next month. The second one, which is probably the most likely, is this goes on for a little while longer. There is some pain. Companies feel pain. The consumer feels a little bit of pain, but it gets flushed out at the June 29th meeting. The third scenario is this goes on and is a full-blown trade war. I don't think that's happening. I think you're seeing each person dig in their heels saying, I'm going to get the better deal. And I'm going to tell people I'm getting the better deal, so I have to push for this.
You know, but I feel like the biggest risk here may not actually be trade, it may be sentiment. Because to your point about December, it was like a dog, right? The dog bites you.
Yeah.
In December, the dog bit. Now for a couple months, the dog is being nice, but you're never going to look at the dog the same way again. We have this kind of day like we had yesterday. I just wonder if that December sentiment, that fear gauge,
it's
going to creep back into the markets.
It's crept back in the market, and it was a purge, sell anything market, regardless of earnings and regardless of what companies were doing. So sentiment is very important. We're watching it closely. We're positioning portfolios for some volatility. You're going to see it.
How so? What specifically are you doing?
Look, alternatives, something that aren't correlated with the S&P 500, some things that aren't correlated with global shakeout, global markets.
Give me a rough example of what that would be.
Like a market neutral portfolio where it's based on more interest rates, because we don't see rates rising or being very volatile unless something really goes bad. Some market neutral portfolios, something that's not correlated to the S&P 500 or global markets.
A little more cash, maybe?
Yeah, you could turn to cash or something that is in the fixed income arena where you pull it off the table, take it out of the S&P, and let it sit on the sidelines for a moment.